Can you just walk my audience through that really important dynamic that you're laser focused on right now?
Yeah, thanks, John. Always good to be with you. So, look, I think it's a very easy concept that most people appreciate and can understand. But when you go into recession, as you know, cost cutting, as you were just talking about, is the focus because sales evaporate. And typically what companies figure out when you go into recession is that they probably did some extra hiring, some extra spending at the end of the last cycle that they probably could have done without. And, we learned that, companies can operate more efficiently. They always can. And a recession, reawakens companies to this efficiency. And so then, of course, when sales return, that efficiency falls right to the bottom line. So it's a very typical pattern. In fact, it happens every time you go into recession. And what's unique about this cycle, John, is we've been talking about is just the speed and how big the unemployment cycle has been this time, right? The pandemic forced companies to lay off people probably more aggressively than they normally would. And let me just give you some numbers on that. Normally it takes about 2 years for the unemployment rate to go from trough to peak in a typical recession. This time it took 2 months. And then, of course, unemployment goes up by about 400 to 500 basis points in a typical cycle. This time it went up by 1,000. So we had twice the size of the unemployment cycle in record speed. And what that means in sort of, operating terms is that we're going to see tremendous operating leverage on the other side, particularly in the context of a fiscal stimulus from the government that is somewhat underwriting this unemployment cycle, right? They're paying people more than they normally would when they're unemployed because of the pandemic.